So when it comes to macro, it's super important to understand the relationship between the bond market and interest rates. So before we talk about the relationship, it's important to know that the actual price of a treasury or a bond is different to the yield. So the yield is like the coupon. It's basically the reward that we get for buying and holding that treasury bond. So knowing that there's a difference between the actual yield and the treasury itself. So there's an inverse relationship. So when the price of the bond decreases, the yield increases because the price of it goes down. So we want to incentivize people to purchase bonds. So the new bonds that are released, the yield is higher or the interest rate is higher. So you get more bang for your buck. You get rewarded more. So that incentivizes people to buy them, and then investors will flood in. So the relationship between the bond market and interest rates is when we raise interest rates, let's say, once we increase interest rates, this is hawkish sentiment. So this is tightening. The central bank is restricting the monetary supply. This causes money to flow out of risk assets. So we'll see fall in commodities like gold, in stocks, and also bonds as well. So bonds are less risky than stocks or commodities, but still they hold some risk. So money will flow out of those into less risky assets. So money will flow into money market funds. It'll flow into people who actually just hold cash. So they'll hold some dollar, yen, Swiss franc, all of these, which are like safe havens. What this will then happen is, so people will sell the bonds to convert it into cash because the interest rates have increased. So when this happens, people have sold the bonds, so the demand for bonds falls, so the price for the bonds falls, and there's an inverse relationship, remember? So then the yield rises. So the amount that you get for purchasing a bond increases. So when yields increase, yields are super important because a yield is basically just the percentage return that you get. This percentage return is super important because this interest rate, this yield, dictates so many other interest rates in the economy. So it will dictate the interest rate on your mortgage, on your credit card, on your business loan. So when yields rise, it makes it more expensive to borrow money everywhere in the economy. So when the central bank increases interest rates, this will cause yields to rise and then also cause all other ways of borrowing to rise. So it just becomes more and more expensive to borrow money. This then reduces spending and obviously slows inflation, but also slows growth. So it's super crucial to be aware of that. And the way that the capital flow will work is, just on a side note, if you want to capitalize on this, if you have money that you want to actually invest wisely and have your finger on the pulse and actually capitalize on this, is when you find out, so let's go with that. When you find out that, let's say, the central bank is increasing interest rates, so I'm going to say, I keep over-explaining, but when they raise interest rates, this is going to cause people to sell bonds. So you can hold bonds. When you find out they're increasing interest rates, you can sell your bonds for, let's say, like the equivalent of a stable coin for US dollar, Swiss franc, yen. Hold your cash there. This will cause the yields to rise. When the yields rise, you can then buy those bonds back for a higher percentage. So you're rotating your capital depending on the monetary policy. This is what the large investors do and how they maintain compounding their capital, and they're not actually just holding one thing, let's say, and just going through all of the peaks and troughs of that. Hopefully that made sense, that relationship between the market and how we can actually utilize it. And yeah, I'll cover more stuff in the next one, guys.